Good morning. My name is Scott Rudd, the Chief Strategic Officer of T3Live.com.
And I'm John Darcy, Editor-in-Chief, and together we bring you the Morning Call. So yesterday, Scott, the market took it on the chin a little bit. It was the biggest sell-off we've seen of the year so far. We've had that steady grind higher, and yesterday put a little bit of a damper on that, or put the brakes on it a little bit. What do you see?
What do I see? I see something different. Finally, there was something a little different in the market where, this trend that we've been following, the portfolio that's been a great way to go since we started 2013, got a little questioned. Started getting questioned earlier in the afternoon or earlier in the morning, and then finally on the 8th day, which we've been watching, we started to, get close to it while a lot of the other indices were breaking it beforehand. So with us being off yesterday, we saw some follow through, to the downside in a lot of the overseas indices.
Yeah, we had some soft European PMIs this morning, which is adding to a little bit of the weakness. And then Japanese markets are down, Chinese markets are down about 3%. So you're seeing world markets sort of are a little bit disappointed that the U.S. sounds like they might take the punch bowl away at some point in 2013 with quantitative easing.
Well, markets trade, and I think people have been waiting for these markets to trade. I know the Chinese market's down 3%. Everyone's like, oh my goodness, but think about where it came from in early December. Same thing with the European indices. Everyone said, okay, the ECB put convertibility risk off the table for their currencies, but what about growth? What about their economies? And yesterday with the PMIs coming in weak, it was a little bit of a reality check, so that caused a little bit of the weaknesses over there. And we shall see what type of corrective process takes place. So we'll measure levels along the way and hope there'll be some nice tradable opportunities.
So Scott, you've been talking a lot about your road to 1700 on the S&P, and so you get a down day like yesterday. We break the 8-day moving average on the S&P. Some sectors show some weakness, but does this do anything to really change your mentality about the long-term picture in the S&P?
No. And at this time, if you look at the chart of the S&P, you'll see that this trend, because trends happen a few different times during the year. Last year, I think we saw like 5, 6 different chart patterns, or maybe a little less, that it was conducive to being a portfolio approach versus a tactical approach. So you go to the chart of the S&P here, you will see this has been the trend since we started 2013. After, here's your New Year's Eve igniting bar, and here's your first day of the year. This is when we held higher, and this has been the 8-day moving average. 8-day moving average has been a really nice roadmap. We talk about the 8 and the 21, and we haven't even tested the 21 until this morning, which we'll get to. Then finally, yesterday we engulfed the prior day, a few of these inside bars, similar to what we had here. But here we didn't have some of the breakdown in some of the other sectors, which we'll get to. But overall, this could lead to a move to right here where we're opening. So if you got short yesterday and you want to take some profits because we're at the 21-day moving average, that's fine. Here's another more micro support at around 14.95. And then if you want to talk a little bit macro, this was the prior breakout of 14.74. Here is the 50-day, which will probably move up to it. And this would be a really nice spot to correct towards, so then guys could refuel from the long side for then the next time we potentially get to the all-time highs in the S&P, we have more fuel to bust through it versus coming from too low in order to have the strength to get there.
Yeah, you have that double top, that all-time double top in the S&P that you've talked about in a lot of your appearances. Over the weekend we were at the trade show, you were talking about that. We got a little bit of a pause below that major level. Is that a healthy sign, or what does that mean to you?
Well, sometimes when you get to old levels, you bring out sellers because people have been trapped and they're just happy to reclaim some of their past money in salvage trades. You look at the longer term chart of the S&P and the monthly, yes, this was the high that was put back, before the year 2000. This was 2007. If you want to quickly draw trends, okay, because we like to follow longer term trends, this trend broke to the downside, and then this downtrend broke to the upside, and then so you can keep doing it again. So now here we are in this current trend, okay? And it's been trending really nicely. So as you come to the highs here, you get some resistance. So at this point, we talked about the potential of them pulling us back. So we could pull back to retest this trend, or pull back somewhere like this, make another higher low, because look, you have a low, a higher low, a higher low, another higher low. So to come back right to here, that could potentially give us the energy to break through that double top and see that S&P 1700, which we've been talking about for the year 2015, which is still a long way away. So I'm sure guys won't change their macro approach. But for us professional traders, we could switch gears on the intermediate level.
All right, shifting back to the short term again, we talked about how we got that close below the 8-day moving average on the S&P, which is what we've been using as a roadmap to sort of judge the composure of this rally. And on February 4th, we also closed below the 8-day moving average. So a lot of traders are just asking now, what's different about yesterday as opposed to February 4th? Why would we not just go ahead and buy this dip and get prepared for the S&P to take back, yesterday's sell-off?
Well, the last two times that it happened, we engulfed the prior day, and I think we even gapped up and trapped the shorts. This time felt different because we were watching what was going on in other sectors.
And the home builders, specifically on Tuesday, they showed a little bit of erratic action, but they were able to pair losses into the close and really avoid a complexion change. But yesterday you saw a major complexion change in the XHB, the home builders ETF, which has been leading the market for the better part of the last year.
And this is what gave us clues earlier in the day, so we could have switched gears later in the day. And if you look here at the XHB, a little different than last time. Back in February, when we took the 8-day, right around here, it wasn't looking so corrective. It looked like a nice controlled pull-in before going again. This is yesterday. We've had a decisive break below not only the 8-day but the 21-day, and we broke this small trend line that's been intact since the start of the year. So that was something different. That was some indicator to get out of some trades or get out of some longs. And now you look at the home builders, it could come into right around here, which I think will be buyable. So here's your more gradual trend line. This is your accelerated one. So depending on what you follow, do you follow the accelerated trend or do you follow the gradual? It's all in your time frame. So I think if you did sell around here, perhaps you could be a buyer of this ETF closer to 27, which is not that far away.
I mean, you look at the ETF, and that's a potent sell-off we see in the XHB, but then you look at a couple of the components of that ETF. Ryland, for example, had a huge sell-off yesterday and is looking to be breaking its major uptrend. And then Toll Brothers was one that reported earnings yesterday and really triggered a lot of that weakness in the home builders.
Well, Toll Brothers came out with earnings, and it was not enough. It gapped lower, and it had a first gap and go. I was here with Brittany yesterday, and I talked about Toll Brothers, and I said, listen, this could be a clue because it's the first time they're not coming after them. And if you look at Ryland, just to show you how you can navigate, look at this gap up, sell down, okay? That is a very bearish day. We call this a day to take notice, and sometimes it doesn't lead to anything. But what it led to is this accelerated trend that broke, and then we even have this gradual trend that broke, and this is below the 821 and 50. So right there, for them to let that happen in that leading home builder, and then Toll Brothers below it, again, gave you some leading indicators to sell some stocks in other groups to see if they follow suit.
Moving on to some more sector ETFs, we also saw the agricultural stocks break down yesterday, also due to earnings of an important member of the sector, which was CF. Very weak earnings from CF, a potent sell-off in that, triggered a complexion change a little bit in the MOO, which is the agribusiness ETF.
Yeah, and this one actually made sense too, because during the last week, you had new highs in a lot of the groups, and this one seemed like it was setting up for that type of trade. But if it doesn't trigger before and then we get weakness, that means it showed relative weakness, and it's probably one of the first to break down. So you go to the MOO, okay, which you look here, you had this symmetrical triangle, which every base on base gets a little bit harder to navigate. This one was up here, and if the market was going to continue, it should have broken above 56, but it didn't. We broke down, so this broke down. So this is below the 8 and 21 day, coming to the 50 day. So this is a relatively weaker group. So you'll see how this handles, the 50, and if the other leading indices start to break their 21, this will probably make it all the way back to this gap, which comes in right around here at 53, 54. And like you said, look at what they did to CF. Pow! They didn't save that. Closing the dead lows, and now it's almost approaching the 200 days. So this is an avoidable group, in my opinion, for now.
And you also had some sectors that held up a little bit better. The chief among them, the XLF, which has been leading this market higher in the absence of leadership from tech in 2013. And the XLF, like we said, it held up a little bit better than all the other sector ETFs, but it did get its first major close below the 8-day moving average of the year.
Right, and this one gave way with the spiders at the end of the day. So it's like those other weaker sectors dragged the stronger sectors down versus the strong ones being able to lift them up, which they've been doing. And if you look here at this ascending chart of the XLF, nice trend, following it along, lots of times to add and take off. And here finally, this day just engulfed the last 4. Okay, broke the 8-day decisively. Here's your 21-day. So if you want to be a shallow dip buyer, this is probably a spot you can do it. And I would say if you're looking at the financials, one of the best keys to it has been Goldman. Okay, and Goldman's been following this strong ascending channel for most of this year. And then yesterday you did have a potent down day. They didn't save it like normal. It's on the 8-day. If Goldman were to break below 154-ish, I do think you can get a move to the 21-day around 150, and then let's hope that holds. Otherwise, this correction could get deeper. It's about time that we get some kind of corrective activity because this one has been unbelievable.
And the final sector ETF we'll talk about is the XLI, which is the Industrials ETF. And that's been another sector that's been leading the market higher with the financials. It closed just a hair below its 8-day moving average. But do you think we could see additional follow-on weakness in the industrials, the financials, and what would that mean for the market if we did get some more downside in the industrials, for example?
It just means that the corrective process will go a little bit further than some of the shorter-term shallow dip buyers would want. So that's why you don't need to be a shallow dip buyer. Like today, if all of a sudden we open down 4 handles and close up 7 handles, you know what? Maybe yesterday was just a brushback pitch. If we open up down 4 handles and we close down 8 and there's no real dip buyers around here, we'll see that, and then that'll mean we need to measure lower levels. And the industrials, which is one of the stronger groups which you want to watch, you go here, it finally had a pretty decisive engulfing bar, engulfed the last 4 days, broke below the 8-day. It's right on this trend line. So I would say right down this area. Here is some pretty key support. If it doesn't take back this pivot, of 40.79, here is your 21-day, which we're not out yet, and then you have your bigger support. So it feels like as I go through these ETFs to check the temperature, you have the weakest ones, which are the ags, the home builders, and what was the third one? The OIHs.
OIH.
Okay, and then on the stronger side, you have the industrials, the financials, and the spiders. So let's see if that changes, when we do start some kind of new trend.
Then you have tech, and we have one bad apple, sorry for the pun, is spoiling the bunch, where it's hard to really take a look at that sector ETF without factoring in the fact that Apple is such a huge component and the stock remains very heavy.
Yeah, and I think if you're going to trade technology, don't buy the Qs, don't buy the ETF. Pick some, got to be a little bit of a stock picker there because you could, tech could have a good move, but the Qs might not if Apple continues to be a drag. So pick and choose your spots. All technology has not been created equal, and we'll get into that further in the regular morning call.
All right, we're going to take a quick commercial break before we jump back in the trenches with a special guest who's going to dive into his proprietary approach and strategy and give you some names that he's watching.
I'm Mark Sperling, Director of Trading with T3 Trading Group and contributor to T3 Live. Do you trade on your own, but you wish you enjoyed the benefits of a large trading floor? With the T3 Live virtual trading floor, we deliver that experience to you on your computer. On the VTF, you can follow the long and short positions of experienced professional traders like myself, Scott Redler, and others, and listen to our live radio stations as we navigate the markets. In addition, you get the added value of a large community of sophisticated and like-minded traders. Your membership to the virtual trading floor also includes access to our 2 very popular newsletter products, Off the Charts and the Price Point Sheet at no additional cost. In my opinion, joining the room will be the best trading decision you will ever make. I would like to invite you to begin your membership with a 7-day free trial. To get started, visit t3live.com and click on the Virtual Trading Floor tab. Have a great day, and I look forward to seeing you in the VTF.
Welcome back in the trenches with a special guest. His name is Joe Hornyak. He has a proprietary algo system in which spits out stocks and strategies for him. So we're very happy to have him here on the morning call. So Joe, welcome to today's morning call. Could you explain to our community a little bit about your strategy and how you go about your day?
Sure. Basically, it's algorithms that have been developed in the works for the last 5 years, been very intense on the algorithmic side, and it's just looking from the markets from a different perspective. A lot of the algos basically, can forecast the direction of the movements of any given stocks or sectors, and basically it's very solid on its approach. It pretty much picks up activities and what's going on in the markets before the actual news hits.
So does it look at technical indicators, fundamental indicators, volume, news, like what's primarily in the formula to correlate or create your algos?
Yeah, pretty much it's purely technical, and it basically looks for activities and movements in specific securities or sectors, and then right before news hits, people are already in it at the right direction.
Okay, well, at this particular point, I know one of the stocks that Joe wants to go over is Netflix, which is good to have him here because we trade Netflix all the time. We do it from a technical approach, so it'll be interesting to hear his thoughts on what he's thinking, and then maybe we can combine them in some fashion. So, what are you seeing on Netflix?
Well, Netflix is a very interesting stock. I've been preaching that one since November of last year. We got into it before the news hit that Carl Icahn took a 10% stake in the stock. And so basically since then we've been running it through the earnings based on the algorithms and did very phenomenal on it. Right now we see a little pullback on the chart since yesterday, and it broke past the 8-day. What we're looking for today is it's probably going to open a little bit lower.
Okay, so let's talk about a lot of the charts on there. So you're saying it's going to open a little bit lower. Here is yesterday's engulfing bar, which is what I see. Here's the 8-day. So what are your algos telling you?
Basically, we have to look for today's movement. If this thing gaps under where it closed yesterday, which is where it seems like it's going to open.
And that price is what, 186.50? Yep.
Yeah, it's. I think right now it's trading around 185 pre-market. This thing, if it opens in this price range and breaks above and closes around the 188, 190 mark, then we're looking good. What we're looking for is a 2-day close above the 8-day moving average, and then I think they're going to try to take back out the 197 highs from a couple of days ago.
So you're thinking that the highs of Netflix are not in for the short term?
Short term, it all depends on today's activities and where it goes. If they break this below the lows from yesterday and continue the trend down, they may try to find a spot where they're going to try to give it some support. Ultimately, it will eventually try to crawl back up and break the 200 spot. And very easily, you know, within this year, 2013, we're looking probably somewhere around 250 to 300 is where this thing could be actually going.
Oh, so your intermediate target is 250 to 300. Short term, we'll watch yesterday's low for more action that way, because I think that's how we're approaching it.
Right.
So that's good. So the next chart you're talking about is ALXN, that stock. What are you thinking there?
If we can pull up a chart real quick on ALXN. Okay. So what we see here is we see on one of the strategies that have been developed, it was called the Infinity strategy. So what we're looking at here is it went down, they took it down a couple of days back. We see some strong support here. If it breaks that trend line, you know, you want to be careful with that. But what we're looking for is an up day today. If it closes on an update today, then the trend should basically pivot and start moving back up to the higher numbers, you know, crawling back up to the 90 to 95 range. In essence, we can see where it was several months ago at the 120 range. But right now, we're just looking for a small intermediary run up to the about 95 to 100 mark.
Okay, well, that makes sense. As I look at the chart, you know, you have big support coming across. To me, this looks a little bit like a head and shoulders top where it's, you know, at a crucial level here where there's your left shoulder, there's the head, here's the right shoulder. So sometimes necklines do hold, sometimes they break. So it does make sense that if it does not bounce in the next few days, or even if it does bounce, I would say short term, you know, there's going to be a lot of resistance coming in right around here. So maybe if it takes out this price point, which is about, what is this, 85.50, perhaps you get your tradable move. But if it can't reclaim that, you know, I think that support, you know, could be, you know, become challenged.
Definitely.
Next stock you have is CIB. Okay, what's the story there?
CIB, if we can pull up a chart on this one real quick. What we notice on CIB is this one is on what's called the Epiphany strategy, and this is a very powerful move, somewhat similar to what Netflix did yesterday on the downside. And what we're looking at here is a strong support where it started basing approximately a month or so back. And I think they're going to be looking to take back out the 68 to 70 range.
So you're saying it's going to cross. So this trend that was broken, because to me this was a sell signal right here, and it's below the moving average. You're saying that this support is strong enough that you could use this as a point of reference that it's going to reclaim this trend line and continue to make highs?
Yeah, again, what we have to look for is today's activity in the stock. If this one closes green anywhere north of where it was from yesterday, it should look strong to do a retracement. If not, you want to be careful, and if it starts to approach the 200-day moving average, you want to see the activity going on over there to see if it's going to support it or if it's going to break through that.
Okay, so I think that, you know, you have points of reference here. Yesterday was actually stronger as the market closed in the low, so that's a good sign. So if it's down a little bit, I think what I would write down is if it could get through 66.97, you know, you could try and retrace, but this is going to be the line in the sand for that stock. And last one that's been in the news, McGraw-Hill, that's gotten absolutely annihilated with the whole lawsuit from, you know, from the government and this and that. And you're seeing opportunities to the long side there?
Yes, definitely. I see some really good opportunities on the long side. What we noticed here, it bounced down to the 43.33 mark, and I was looking at some key numbers over there for support. It only closed above that below that 1 day, and as long as it held above that 2 days in a row, we're looking at a strong uptrend. Right now, I see some exhaustion on the short side. I don't think the shorts have really begun to start covering it yet. So as long as it holds that 8-day moving average in within 2 days of trading, I think they're going to try to take it back up to the 21. So we're looking at anywhere from short term about 47, 48, and more intermediary return, I think they're going to start taking it back between $48 and $52 range.
Okay, I think I like your strategy here. It's been battered and bruised from 58. This one broke a key level, continued, seems to be stabilizing. You had your king and queens formation here where it made a low, engulfed it, traded above it. So I would say also if it could stay above this 44-ish area, there's good probability it breaks this and then at least retest to 48, and then I guess you're going to have to figure out what the news flow is like there.
Most definitely.
All right, so it's interesting. So your algos it seems like they take a lot of technicals into play here because a lot of it has to do with also what happens now could happen then. So it's a lot of price points.
A lot of price points, a lot of proprietary algorithms that have been developed using different types of technical analysis tools. If you want more information on it, you can find it at www.excelsiorwallstreet.com.
All right, well, thanks, Joe. We're going to take another commercial break. Thanks for coming today.
Thank you. Good being here.
Most people say you can't time the market. I say you have to. I'm Scott Redler, Chief Strategic Officer for T3 Live. I would like to invite you to an exclusive swing trading event in Newport Beach, California on Saturday, February 23rd. Students will learn the 5 keys to becoming a successful swing trader and how to navigate the market using what I call a portfolio approach when it's conducive in the market. Reserve your seat at t3live.com or call our toll-free number 1-888-99-T3Live.
I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, we teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.
Welcome back to Quick Hits, where we'll dive through a few pertinent names in this market very quickly to finish off the show. We'll start off with Apple, which I alluded to a little bit as the bad apple that's spoiling the tech bunch, and Apple continues to be a drag. You had that whole drama with the Foxconn plant. Some people thought that the hiring freeze was potentially due to slow iPhone 5 demand. Some people are saying it's due to the Chinese New Year. Either way, people didn't want to buy the news.
Yeah, either way, the market or the stock's been under pressure. Every now and then we get a few-day rally. 2 weeks ago, we had a really nice rally from like 445 back to 485. It filled the gap. And the question was commitment going to stay with this stock heading into the shareholder meeting? Then if you remember last week, we talked about 463. 463 gave way, then it just turned back into the same apple that's been trapped in this downtrend since 700. If you look at the chart here, you will see ever since 700, this descending channel has been controlling this stock. Every time it's rallied back up to it, it's failed. Last night's move was right around here. This was the day it woke up, got back on our radar, and it was able to be held for a multi-day swing to fill this gap. And then boom, it's been just trickling lower, closed on the lows yesterday. It's down a little bit today. Some of my guys might look, including me, for a cash flow trade if it can go positive, if it could take back yesterday's low of 448.80. But overall, you have support right here at 442, and then you have 435. Still trapped by this trend line. Don't know if it's ever going to be able to take it out. Let's hope that the investor shareholder meeting is much better than what Tim Cook did at the Goldman Sachs conference, which basically he called Einhorn a sideshow, and that was pretty much the only reason why it rallied. So hopefully someone consults him on how to deal with the shareholders.
Yeah, they need some kind of catalyst. We talked about it, whether an iWatch or a new special dividend, something to wake it up, because right now there's nothing to push it.
They need a big dividend and they need a big buyback. People don't really care about products right now for some reason, because the products right now are great. The supply is being met by all the demand that we had. Those demand problems are being met. I remember way back when everyone was going for an iPhone 5 and you had to wait 6 weeks, or the iPad Mini, they had to wait even more than that, whatever. Right now things are running pretty smoothly, but at this point no one really cares. They don't care if it's a 9P, an 8P, or 7P. They want to see something being done with the cash. They want to see some kind of technical sign that this downtrend changes. And when we do see that sign, maybe the glass will be more half full versus half empty, and this has been far from a quick hit.
All right, Google, yeah, it was a not so quick hit. Google has been the much more compelling stock in the sector as it's trading near highs. This morning we checked it and it looked like it was going to be up a little bit with the futures down a few handles, so that just goes to reinforce the strength we've seen recently in Google.
I know as I was taking the ferry and I was like, okay, Google just was down 13, 14 bucks yesterday. If it's down another 3, 4, that's something I'm going to turn to and look to buy for a trade and see if it could hold in there. And then you come in and on the news, I think Bernstein raised their price target north of 90, so did someone else. And I think someone even put a $1,000 price target, and we know what every time some company gets a $1,000 price target, it's like the kiss of death. Anyway, you look at the chart, it's been an unbelievable run. Here was your reversal back here in November. This is when, it broke this downtrend. If you didn't take it, this is where it was earnings. You could have bought it after this gap up, and since then it's been stair-stepping higher. Yesterday, small reversal. Some guys made some money short, whatever. Holding the 8-day moving average, it's up a little bit. If it can get back above 800 and go sideways, chances are that this could remain intact and continue. But at this particular point, just don't buy it blindly because you're hearing these big price targets, because typically that happens after a momentum move, and it's not that prudent.
Yeah, and we'll move on to the TBT, which we saw hold up yesterday, still trading in a tight range. Do you see the TBT, which is the inverse bond ETF, having more upside?
You know what? I've been trying to be long the TBT, and it's been okay at times, but it's sloppy yesterday. Just because I was cleaning up positions, I got out of my TBT. But I think the next day or so will be, I would say, important for short-term direction. If you look here, I was hoping that the catalyst would be with the Fed, where it could have taken out this bigger resistance for a nice juicy trade. I'm not saying it can't happen; it still can. So I stopped myself out early. Really, truly, if you're an intermediate guy, you could wait till the 21-day around 67. I just did it because it closed in the lows, and I was just trying to clean up. But I would get back, me personally, back in this trade if it does hold and go sideways, because then at some point it could trade above 69 and give you that bigger move. Because you go to the monthly chart in the TBT, it seems like it had a big move, but obviously look where it was and look where it is now. So, I think there'll still be better activity there, but a little bit further down this year.
And the final thing we'll touch on is gold, which it's always sensitive to Fed announcements and Fed minutes. And it broke that triangle pattern that we had been talking about a couple weeks ago to the downside, and just continued to bleed lower. And it seems, based on the price action, that somebody knew that the comments out of the Fed minutes were going to be a little bit more hawkish than we've seen over the last few years. Several Fed governors want to start to slow down the asset purchases in QE and start to tug on the reins a little bit as economic conditions improve and inflation dangers grow a little bit. Gold sold off hard yesterday. Is there any spot coming up that you would look to try maybe a little?
Well, gold's interesting because you have so many different types of people involved in it. You have guys who've been in it for a decade, guys that just traded on the intermediate trends, and some that just day traded. So the last trend that broke was when that triangle we spoke about resolved to the downside when it broke below 161. Okay, I'm talking GLD or 160ish. You look at the chart pattern here. Remember when it was getting really tight, and I actually was cheating to the upside, and I wound up losing money and got stopped out. Well, here it just pretty much filled the void all the way back down to more macro support. So it is up a little bit with the futures down. I would say, there is an opportunity. First, let's see if it could take back at least half of yesterday's move to show that this was somewhat emotional. Then you have the gap that could be filled to here, where the moving averages will move down. But if it fails today and breaks through this 150.84 yesterday's low, which I don't think it will today, but it can, then you have this big macro support. And look at the macro support here. This is macro support that's been in place, for a long time. That's where it held last year, and that's where it's coming into. If you go to the monthly chart, macro investors in gold are going to have to start waking up here a little bit. Okay, guys, get out of your bug cave, because you could be bugging out if this gold breaks below this 148-ish. Because if it breaks below this 148, 150 with a decisive move, next real spot is 140, maybe even down to 134. So, I know that you guys are saying this is healthy consolidation sideways after a huge decade run, but I would just pay a little bit more potential, pay a little bit more attention. As yesterday I tweeted, I'm like, what, if you're on an intermediate trend trade and you're short gold, don't be a piggy, cover some, and then we'll figure out what the next move is.
All right, well, that'll do it for today's morning call. Join us on the virtual trading floor. Even the bulls welcome a little bit of a pullback to loosen up the market a little bit, so maybe we'll get some more action, some more opportunities over the next few days and week. We'll see you out there.